Relative Strength Index, or the RSI, is a popular momentum indicator that was developed by Wells Wilder in the 1970s. Underpinning it is the concept that prices have a tendency to close higher in uptrends and tend to close lower in downtrends. Most traders look at the 14-day RSI, which looks at the average rise on up days over the past 14 sessions compared to the average fall on down days over the same period. However, it can be shortened to, say, 9 days if the market has very low volatility. Shorter timeframes make indicators more sensitive, but equally they increase the chances of whipsaws or false signals. The RSI is bound between 0 and 100 with key levels at 30 and 70. Below 30 suggests that the instrument is oversold, whilst above 70 suggests that the instrument is overbought. However, be careful in strongly trending markets because an instrument can remain above 70 or below 30 for a significant amount of time. What about buy and sell signals? Well, some technical analysts use a push above 30 as it exits oversold territory from below as a buy signal. Similarly, a push below 70 as it leaves overbought territory can be seen as a sell signal. Another way to use the RSI is to spot something called failure swings. These are a potential early warning sign of a market reversal. A failure swing takes place when the RSI is in either overbought or oversold territory, so it's either above 70 or below 30, and there are two types of failure swings. If the RSI is above 70 and prices are rising, making a higher high, yet the indicator fails to make a higher high, that's called a bearish failure swing, when an indicator fails to confirm price action. Similarly, if the RSI is below 30 and prices are falling, prices make a lower low, yet the indicator fails to make a lower low, this is a case of bullish divergence, suggesting that prices might be about to turn higher. Now, the RSI is a very popular indicator because there are a few drawbacks. It's simple to understand based on momentum and generates buy and sell signals and allows us to see when an instrument is overbought or oversold, and it can show us early warning signs of a trend change. But remember that these indicators should always be used secondary to price, so make sure to study the price action first. Let's take a look at a real-world example now. This is the chart of Eurodollar, as you can see here, and I've got the RSI indicator below. We can see it's the 14-day with the 70 level and the 30-day level marked on the chart by these two lines. Below this lower line, 30, indicates that it's oversold, shown by this green line. Above, it is overbought, indicated by a red line. This is where we got a buy signal from the RSI, which, as you can see, coincided with the low from the 20th of February. That was when the RSI pushed from below 30 to above. Similarly, we got a sell signal here on the 10th of March when the RSI pushed from above 70 to below, and that really was at the peak there from the 9th of March. Thirdly, I wanted to point out a failure swing. In this case, it's a bearish one where prices are making higher highs, as you can see, yet the indicator is failing to confirm this price action and is in fact exhibiting lower lows. That can be an early warning sign of a trend change.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.